Warren Buffett may be the world's most mimicked investor, but he's not the only proven stock picker we can learn from. Peter Lynch, who served as the Fidelity Magellan Fund's lead manager from 1977 to 1990, FMAGX 1.25%, might provide investors with some of the most valuable advice straight from the horse's mouth. Accept periodic losses to win in the long run. People who succeed in the stock market also accept periodic losses, setbacks, and unexpected occurrences. Calamitous drops do not scare them out of the game. Like the majority of successful investors, Lynch adheres to the school of thought that believes making long-term investments is essential to becoming a successful investor. He suggested that in order to be successful over the long term as an investor, you should stay away from the two emotional states of concern and capitulation. After the markets experience a significant correction, the first state, concern, emerges. This is now a fantastic opportunity to benefit from this correction. However, worries prevent you from purchasing good investment chances at low costs. When your investments decline due to a market correction, you experience the following emotional state, capitulation. Lynch notes that many investors consider themselves to be long-term holders, but only up until the next severe decline, after which they swiftly change their minds and become short-term holders, selling out at a loss. Know what you own and why you own it. The economic world of today is full of hot recommendations, whether it be trading using futures or options, betting on a hot stock, or purchasing a cryptocurrency that claims to send you to the moon. And regrettably, many people follow such get-wealthy-quick advice. This makes Peter Lynch's advice to know what you own appear even more timely in today's society. According to Lynch, you shouldn't own a business if you can't explain what it does in 30 seconds or less. The same may be said for any form of investment. You should only invest money in financial products such as stocks, annuities, insurance, mutual funds, and other types, once you have a thorough understanding of how they operate and the dangers they involve. Even if you won't get rich overnight, you will make good returns and be able to sleep well at night. Know why you own it. The second piece of advice is equally crucial. You're more likely to steer clear of any impulsive investment errors when you match your wise investments to the financial objectives you hope to achieve. This is because you are aware that if you stop investing, your goal will never be attained. You will be able to deal with negative market moves better and become a better investor thanks to this disciplined approach. Don't stop your winners. Let your winners run and cut your losers. It's easy to make a mistake and do the opposite, putting out the flowers and watering the weeds. Peter Lynch. Throughout his career, Lynch bought a variety of stocks. Some of his investments did poorly, some did all right, and a select handful of them produced extraordinary profits. He was able to provide extraordinary returns over the course of his career by holding on to his top performers rather than trying to make money off of them after brief rallies. To characterize a stock that increases in value tenfold or 1,000%, he created the phrase 10-bagger, and his first rule for identifying a 10-bagger stock was to hold off on selling it until the company's fundamentals changed. Even if these equities rose by 40% or even 100%, he would continue to hold on to them. If you are outstanding in this profession, you are right 6 out of 10 times, says Lynch. However, your victories should outweigh your errors. The lesson here is to be patient with your top-performing investments. Even though they're far from their financial goals, many investors feel the temptation to book profits after seeing strong gains from their mutual funds over the course of a year. As a result, they miss the opportunity to benefit from compounding's exponential returns and achieve their financial objectives. Profit booking is rational, but only in the context of rebalancing your portfolio in accordance with your asset allocation. Consider the scenario where you have opted to balance your portfolio with 30% of debt and 70% of equity. The stock component of your portfolio has increased to 80% following an equity market rise. If this is the case, you can book profits on equity investments and reinvest the money to balance out your portfolio's exposure to different asset classes. You cannot kiss all the girls. You don't have to kiss all the girls. I've missed my share of 10-baggers and it hasn't kept me from beating the market. Kissing every attractive female wasn't a realistic ambition for Lynch when he was in high school and college. According to his book, One Up on Wall Street, investments are subject to the same rule. All the top-performing stocks and ETFs are not available for purchase. Although I have missed some supermodel stocks, I have kissed some pretty stocks in my career too. I wish I could have invested in more stocks that increased multifold, but this has not hurt my long-term performance. Many investors make the error of choosing funds based on their success from the previous year. They continue to alter their mutual holdings when the list of top-performing funds changes. This leads to a disorganized portfolio and is detrimental to their goal of building wealth. That is why it is preferable to stick to a winning strategy of discovering and investing in good, reliable funds, rather than chasing after every beauty or top-performing fund on a short-term basis. If you follow this straightforward formula, you can get gorgeous, long-lasting results. Enter early, but not too early. Lynch suggests avoiding undue risk by delaying your investment in any chance. He compares it to placing a wager on a baseball team before the starting lineup is known. Enter early, but not too early, he instructed. I frequently compare investing in growing businesses to baseball. A corporation has already proven itself by the third inning, so try to join the game then. You're taking an unnecessary risk if you purchase before the lineup is revealed. One error that many investors commit is to immediately purchase a new fund offer, NFO, believing that this is a fantastic opportunity. They're unaware that investing in NFOs is equivalent to taking a chance. An established plan with a successful track record is always preferable than something novel or unforeseen.